Hey everyone, welcome back to Corporate Decoder. Today we're diving into some amended financial reports, which usually means something went a little sideways or they just wanted to make sure everything was crystal clear. Let's just say it's like finding a typo in your report card after you've submitted it, but for a publicly traded company. Primis Financial Corp is filing this amended report to clean up some financial details from their second quarter earnings. Think of it as a do-over, or more precisely, a correction to a previous filing. They're essentially saying, oops, we need to adjust these numbers, and we're here to figure out why and what it means. If you love getting straight to the heart of corporate filings, make sure you're subscribed. We also have a Discord community where we break down these kinds of reports even further, and the link is right there in the description below. So what prompted this correction? Well, it all comes down to valuing loans. The company had to reevaluate 3 specific loans that were previously performing well. Recent information led them to downgrade these loans, meaning they are now considered riskier. This is a pretty big deal because how a bank or financial institution values its loans directly impacts its reported profitability and financial health. When loans get downgraded, it often means the borrower might have trouble paying them back, leading to potential losses for the company. Let's look at the first loan. This was a commercial loan with over $6 million still owed on it. It was downgraded to special mention. Now, special mention might sound mild, but in the banking world, it's a warning sign. It means there's something that could potentially become a problem if not watched closely. The good news, they say, is that the loan is secured by business assets and the company's debt-to-value ratio is pretty low, around 38% based on a recent capital raising event. This suggests that even if the borrower defaults, the company might be able to recover a good chunk of the money by selling the collateral. Next up, a much larger loan, over $30 million secured by an office building. This one got a more serious downgrade to substandard accruing. Substandard means the loan has some weakness or deficiencies that put repayments is 1.1's done. It's definitely on shaky ground. The filing mentions this loan hasn't missed any payments, and its debt service coverage ratio, which is how well the property's income covers the loan payments, is 1.13 times. That's just barely over the threshold, meaning there's not a lot of cushion. The company's management reviewed it and decided it wasn't impaired yet, meaning they don't expect to lose money on it right now, but the downgrade definitely flags it as a higher risk. And now for the biggest concern, another office property loan, this time for over $40 million. This loan has been downgraded to substandard non-accrual. Non-accrual is a very serious designation. It means the loan is no longer generating interest income for the company because payments are a significant chunk of money and a clear indicator of trouble. Adding to these downgrades, the company also had to reverse about $300,000 in accrued interest for that non-accrual loan. This means they previously thought they'd earn this interest, but now they won't. They also reversed another $600,000 in reserves set aside for the other substandard loans. When you comb through all these adjustments and account for taxes, the net income for the 3 months ending June 30th took a hit. Instead of the previously reported profit, their net income for that period dropped by $6 million to just $2.4 million. That's a pretty substantial adjustment, wiping out a significant portion of their reported earnings for that quarter. This whole situation is covered under item 2.02 of the report, which deals with the company's financial results. They've attached an updated earnings release that includes all these revisions. It's important to remember this is an amendment, meaning the original report had different numbers. Then there's item 701, which is about their investor presentation. This is the material management uses to talk to investors. So they're also updating the presentation that they'll be using from now on to reflect these corrected financial figures. Effectively, they're trying to make sure everyone is working with the right set of numbers going forward. It's worth noting how this information is being presented. The company is furnishing this amended report, which generally means it's for informational purposes and doesn't carry the same legal weight as a filed document under certain securities laws. This is a common practice when correcting information to avoid certain liabilities, but it doesn't change the fact that the underlying numbers have been adjusted. Finally, under item 931, they list the exhibits. The key ones here are 99.1, the amended earnings release, and 99.2, the amended investor presentation. Think of these as the corrected storytelling documents that accompany the official filing. And of course, the report is signed off by Matthew A. Switzer, their Chief Financial Officer, on August 11, 2025, confirming the accuracy of these amended figures. Now let's look at what this all means for Primis Financial Corp. The core issue here is the downgrading of these loans, particularly the 2 designated as substandard. This indicates a potential weakness in their loan portfolio, especially when it comes to commercial real estate, which, as we know, has been facing headwinds. The fact that the company had to take a $7.7 million reserve on one loan is a significant event that directly reduced their reported profit by $6 million. Warren Buffett often talks about the quality of a company's assets, and for a financial institution, those assets are its loans, a significant portion of their loan book, especially commercial real estate, which, as we know, has been facing headwinds. The fact that the company had to take a 7.7 a financial institution, those assets are its loans. A significant portion of their loan book, especially commercial real estate, is showing signs of stress. While the company is trying to put a positive spin on the secured nature of some loans and management's evaluation that they are not yet impaired, the reality is that these downgrades and the need for a substantial reserve are red flags. It suggests that either their initial underwriting was too optimistic or the economic environment has deteriorated more than they initially anticipated for these specific borrowers. This could impact future earnings if more loans are downgraded or if these specific ones lead to actual losses. The company's direction here seems to be focused on managing these problematic loans, but the significant adjustment to their quarterly earnings does raise questions about the stability of their income stream. The opportunity they have is to successfully navigate these challenges, recover value from the collateral if needed, and perhaps learn from this to tighten their lending standards. The risk, however, is that these issues could be broader, leading to further downgrades and larger write-offs impacting their capital and profitability. In conclusion, Primis Financial Corp has adjusted its earnings significantly due to loan quality issues, particularly with commercial real estate. While they are providing updated information, the need for these corrections, especially the large reserve, suggests underlying risks that investors should monitor closely. It's a reminder that financial reports are not just about the headline numbers, but the details behind them, which often tell a more complete and sometimes cautionary tale. What's your take on these figures and what they signal for Primis Financial Corp? Drop your thoughts in the comments below. If you found this deep dive valuable, please hit that like button. It really helps us out. And if you want more of these corporate breakdowns, make sure you subscribe. Don't forget to join our Discord community, linked in the description, for even more insights. Thanks for watching, and we'll see you in the next one.